In 2019, we spoke a lot about the importance of minimising losses and protecting investors' capital in order to outperform over the long term. And of course, we spoke at some length about the risks we see in markets. We're now in a new decade, and as the 2010s end, our goals-based real return funds celebrated their 10-year anniversary. Over this time, we've been very prudent with investors' capital, focusing on risk, making sure we manage the portfolio for losses. When we've seen opportunities that have a margin of safety, as Warren Buffett calls it, we've invested heavily. Things like Japan after the 2011 earthquake or UK banks the day after Brexit in 2016. On the other side of the equation, we've been really cautious to invest clients' money where we felt we're putting capital at risk. This has been the case with US and Australian equities over the last couple of years. We may have missed out on some of the upside, but our focus has been on meeting our clients' goals over the long term, not 2 years or 18 months. Sometimes these are uncomfortable investments to make or to avoid, but we think it's best to be fearful when others are greedy and greedy when others are fearful. Because markets are stretched and almost at extremes in some cases, we should expect lower returns over the next decade than what we got from the 2010s. Markets are priced for interest rates to stay low for a long time, and they'll be very sensitive to any sign of upward movement in interest rates. The important thing for us as value investors is to stay true to the process, focus on valuations and manage the risk to investors' capital. So we continue to be invested in areas where we see value, like Europe, the UK, emerging markets and Japan, and we'll allocate less to areas like US and Australia or even the bond market, which looks very expensive. We'll hold cash and seek to deploy it when we find the right opportunities. Our approach is really the tortoise as opposed to the hare. So I'd expect us to continue to lag our peers in strong up markets, but protect capital much more effectively when markets sell off. And when that sell-off happens, we aim to capture as little as possible of the downside, which means we don't need to take huge risks on the upside and still outperform over the longer term. We undertake this style of investing because it's really focused on enabling investors to achieve their long-term financial goals.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.